to the high of this candlestick, we have the fair value gap. And now we can see the fall of price. Here we have our valid pullback, price fell. So here we have the internal buy side liquidity. We also have this buy side liquidity. Now price returned, took out this liquidity. Price fell to the downside. Price pushed further to the upside. And we can see price created relatively equal high points here. The market fell again to the downside, failing to push to the downside to take out the external range liquidity. Now what we're seeing is this movement to the upside. Since price created this relatively equal high points, we're expecting to see the push of price into our order block or the fair value gap. Hello guys, welcome to the next World Trading Hub YouTube channel. In this episode, we're going to be looking at how to utilize the fair value gap and the optimum trade entry level using the Fibonacci retracement tool. A lot of traders have this concern. They identify their order blocks, which is basically their point of interest, but then price doesn't mitigate their order block, and then you will discover that price will move in the direction they're anticipating that the market is actually going to move towards. So in this video, we're going to treat how you can utilize the fair value gaps before your order blocks in confluence to the optimum trade entry level using your Fibonacci tool. So what we can see from the chart here, we have a bearish market condition. We can see the market fell to the downside. We have our buy side liquidity, which we can call our inducement. So the market returned to take out the buy side liquidity, and then we have a valid higher low point here. Price took out the buy side liquidity. This validates this low point, and then we have the impulsive move to the downside that took out the external range liquidity. After price took out all internal range liquidity, we can see that now price took out the external range liquidity, where we now have the valid break of structure. Price created this pullback, which is now our buy side liquidity, or you can regard that as the inducement. In case you do not know how to mark out ideal institutional valid structure, so you can check out in the YouTube channel or in the description link to this video, you're going to see a video attached to this particular video on how to identify institutional structures. So what we can see now, price pull back to the upside, took out the buy side liquidity. This validates this as a lower low point. Price printed our new lower high points, and then we have the impulsive move. Price took out this, giving us a valid break of structure. We can see that this is a valid lower low point because this took out internal range buy side liquidity. Now we can see the drop of price to the downside. We have this pullback, price pushed to the downside, pullback, price pushed to the downside. So we have buy side liquidities. This is our most recent liquidity, which is now our inducement. For this to be validated as a valid lower low point, we want to see that price retrace to take out internal range liquidity or fill up inefficiencies. So we can see that the market pushed to the upside, took out this buy side liquidity. We have the fall, but then price did not move to the downside to take out the low points. We have another push of price. So you can see within the pullback leg move, we're having this bullish market structure. Price fell to the downside. And now what we can see is that price took out the inducement, the buy side liquidity, failed to push to the downside to take out the external range liquidity. We have the pullback again to the upside. Price returned to the downside, failed to continue the movement to the downside. Now what we can see, price created relatively equal highs here. You have this swing high, and we also have this swing high points here. So we have liquidity pool resting above this buy side liquidity. So you can see that now price took out this buy side liquidity, pullback, pushed to the upside, created this high point, which is relatively to this other high points. So we have liquidity pool resting here. Now we see the push of price to the downside failed to give us the impulsive move to take out the external liquidity. And then we saw that the market is pushing to the upside. What we can see from this theoretical diagram for explanation is that what we can see is the impulsive move to the downside. So basically we have a fair value gap here. This is our order block, meaning this is our bearish order block. So ideally the anticipation is we want to see the pullback of price to the upside into the order block before we can frame a bearish move of price to the downside. But what we can now see is that the market took out the relatively equal high points, which is actually our liquidity pool, mitigated the fair value gap, and then we have the fall of price to the downside. You can clearly see that the market did not mitigate the order block. Price mitigated the fair value gap, and then we have the impulsive leg move to the downside that broke the structure to the downside. So we have a valid break of the swing low. So this is now where we have our break of structure. Price failed to return to the order block, which you can regard as your POI. So in this particular episode, we're going to look at how you can utilize the fair value gap in confluence to the optimum trade entry levels using the Fibonacci tool. So when we actually now plot the Fibonacci from this swing high to this swing low points, for us to actually execute our trade, we want to see that price will trade above the discount price zone into the premium since we are in a bearish market condition. So we want to see price straight to the equilibrium or to the premium price zone. And we can see that this particular chart illustration, we can see that the market pullback to the premium price zone, which is in confluence to the fair value gap. And then we have the fall of price to the downside. And when you're identifying your fair value gap, you want to pay attention to the institutional order flow before the impulsive move that took out the structural swing low points. So we're going to head to the chart to look at practical examples so that you can have an understanding to these theoretical concepts. So guys, we're going to be looking at real-time chart examples. So here we have the Euro USD. This is the 1 hour time frame. So we're going to be using the 1 hour time frame as the time frame where we've established our structure. So we can see the fall of price to the downside. We can see buy side liquidity, price return took out all internal liquidities, and we have the fall of price to the downside. We can see this is the pullback before the break of structure. So this is our inducement, but then price fell to the downside, took out this, gave us another pullback. This become our newly firmed inducements. Price fell, we have a valid pullback here, and we can see how the market returned to the upside, took out the internal liquidity, our inducements, and then we have the fall of price to the downside, breaking the structure to the downside, taking out external range liquidity. So we have a valid lower low point because this sponsored the bullish move that took out internal range liquidity. And now we have the impulsive move to the downside that broke structure. So what you can see is that we have this displacement of price to the downside that broke structure. And what we can clearly see from the chart example, we have the fair value gap. So we can see the impulsive move. This impulsive candle took out structure to the downside, creating the fair value gap. Price fell, give us this push to the upside. We have this up close candle. So from this candle low point, which is the order block, the last up close candle before the bearish move. So from the low of that candlestick to the high of this candlestick, we have the fair value gap. And now we can see the fall of price. Here we have our valid pullback. Price fell. So here we have the internal buy side liquidity. We also have this buy side liquidity. Now price return took out this liquidity. Price fell to the downside. Price pushed further to the upside. We can see price created relatively equal high points here. The market fell again to the downside, failing to push to the downside to take out the external range liquidity. Now, what we are seeing is this movement to the upside. Since price created this relatively equal high points, we're expecting to see the push of price into our order block or the fair value gap. So I want to show us how to trade from the fair value gap zone without waiting necessarily for price to return to the order block. Because in such scenarios, you would see that the price or market doesn't return to the order block. Price would mitigate the fair value gap, and then we have the drop of price to the downside. What we can see is this displacement. This displacement led to the break of the structure. So price would want to return to mitigate the candle that led to the displacement to the downside, the massive displacement that broke structure. And this is the bearish candle where we have the displacement to the downside. And we identify the fair value gap. We have pools of liquidity sitting here. Prices failing to create lower low. We can see a bullish market condition. Price wants to take out the relatively equal high since we have a sponsorship zone yet unmitigated. So this is our fair value gap. When we use the Fibonacci tool, what we are going to see from the swing high points here to the swing low points here. So what we can see is this is our 50% price zone. This is the premium level. This is the 61%. This is the 75%. So we can see that we have the fair value gap within the optimum trade entry price zone. This is the premium zone. So we're anticipating, since we are seeing that price mitigated the equilibrium, fell, but price failed to push further to create a new lower low, taking out this external range liquidity, and we're seeing the push of price to the upside. Price closed above the equilibrium. So our anticipation is to see the push of price into premium. And within the premium zone, we have the optimum trade entry levels, the 61%, the 75%. And what we can see are relatively equal highs are in confluence to the 61%. So our anticipation is to see more deeper push of price into premium. In confluence to the premium zone, where we have the fair value gap, you can see we have this breakout block. This is the last down close candle before this bullish move that took out this buy side liquidity. And then we have the displacement to the downside that broke this particular sponsorship candle. So this is our breakout block. And in confluence, we have the fair value gap and the optimum trade entry price zone, the premium price zones. So now we're going to drop to the 5-minute time frame to take our entries from the 5-minute time frame. So we want to see price take out these relatively equal highs, which are the buy side liquidity. So our anticipation for the bearish continuation is to see price take out the sell side liquidities. We have this internal sell side liquidities, and here lies the external sell side liquidity. You know, we are in a bearish market condition. So we do not have a market structure shift until price takes out this high points. So we are going to utilize the 5-minute time frame to frame our entries to see how you can utilize the fair value gap in confluence to the optimum trade entry level using the Fibonacci tool. So let's drop to the 5-minute time frame. So here we are in the 5-minute time frame. So we can clearly see our relatively equal high points. And now we can see our fair value gap, which we identify from the 1-hour time frame. So one thing you must also understand is when you identify the fair value gap from the higher time frame, there is the existing possibility that within that fair value gap, when you drop to a lower time frame, you're going to identify an order block, which clearly you can see here. We have this order block here. So let's pull out this order block, anticipating to see that price would return to the order block, which is within our fair value gap and the optimum price entry level using the Fibonacci tool. Let's change the color of that. So we have identified the order block within our higher time frame zone, which is the fair value gap. You already know is in confluence to the optimum trade entry levels using the Fibonacci tool. So we can see now we have the order block in the 5-minute time frame. So that is another established confluence to actually execute your trade using the fair value gap identified from the 1-hour time frame. The fair value gap from the 1-hour time frame gave us the displacements that took out the swing low. Within the fair value gap, the institution created the order block. They gave us a bullish move within that fair value gap we identify in the 1-hour time frame. So now in the lower time frame, this is the bearish order block that sponsored the break of this structure. But in the 1 hour time frame, we're going to see an impulsive bearish candle to the downside. So we can see the relatively equal high points are liquidity pools. So let's play price to now see how you can frame your entries within the zones we've identified in confluence to our fib level, the premium price level. So let's play price to see. Now we can see prices pushing to the upside. Now we can see how price returned to the upside. Price mitigated the breaker. This is the breaker we identified. The black horizontal line you're seeing is the breaker we identified from the 1 hour time frame. And above it is the 5 minute order block in confluence to our fair value gap from the 1 hour time frame, our displacement. Now we can see that price have mitigated the order block and the breaker and mitigated the fair value gap. Now, what we can see is we have this swing low points. So we're looking forward to see how price is going to take out this swing low points. Then we can begin to frame our bearish move of price to the downside, anticipating to see that the market will first take out this sell side liquidity. So we'd want to identify a zone below our sell side liquidity where price has the probability of facing rejection from. And what you can see is we have this order block, price push to the upside, we have this pullback. What we can now see, we have this mitigation block. We'll be looking forward to see that the market will take out our sell side liquidity and face a form of rejection at this mitigation block. So let's play price to see what happens. Now we can see that price took out the swing low points. Price mitigated the order block in the 5 minute time frame in confluence to a higher time frame zone. You can see this is price push to the upside, a pullback, price push, pullback, price push to the upside. We have a valid pullback. Price took out that low. So now we have a market structure shift here. So our anticipation is we want to see the pullback and then price falls to the downside. So now we can see that price is pushing to the upside. Ours now is to utilize also the Fibonacci tool to determine where we could possibly take our entry. Now, from the swing high to the swing low, you can see this is our equilibrium. And we have this fair value gap, which is within the premium. So here we have the fair value gap above the equilibrium price level. This is within the premium price level. So we can frame our entry from this fair value gap, which is within premium zone. Since we have a market structure shift, price took out the swing low points. So we could take a short position by utilizing this fair value gap. So we can place our entry here, our stop loss above the swing high. And then we look forward to see how price is going to fall into our zone where we're anticipating to see the sweep of this sell side liquidity, which we identify from the 1 hour time frame. So let's play price to see what happens. Okay, we can see price is still within this broken zone. Price have not returned into this zone. So let's play price to see. Let's see if the market actually activated our entry. Okay. Now we can see we have an entry here, a Snapple entry. Wow, that's awesome. So let's play price to see. Now what we can see is the market have activated this entry. Now we have a break of structure here to the downside. So we have this break of structure. Now our anticipation now is to frame another entry. Now we can now use the Fibonacci tool. I'm trying to show us how to use the Fibonacci tool in confluence to fair value gap zones. So now we have from the swing high to the swing low. And what we can see is this is equilibrium. Price have returned into premium. In confluence to the premium, we can see we have this fair value gap and we have the order block. The up close candle before the bearish move to the downside that took out structure. So let's take out the fib tool and then we can also now put another entry from this fair value gap and our stop loss above the high. We can also still target our sell side liquidity. We're looking forward to see that price is actually going to raid that sell side liquidity. So let's play price to see. Okay. So we can see that this rated our stop loss. So, but we are still in this particular trade. So let's play price to see. Now, what we can also now identify again is we have this break of structure to the downside. So we have another valid break of structure. So let's do away with this since price rated the stop loss. So we have another break of structure here. Now, ours is to identify the pullback. We want to anticipate to see where price is going to mitigate, and then we have further push of price to the downside. What we can see is we have this order block here, this order block, the extreme point of interest. We have this buy side liquidity. So let's play price to see if price is pulling back to the upside. Okay, we can see that the market is pulling back to the upside. Now you can utilize the Fibonacci from the swing high to the swing low. So this is equilibrium price and this is our premium price zone. In confluence to our premium price zone, what we can see, we have this mitigation block because this failed to take out this swing high point. So we have this mitigation block. In confluence to the mitigation block, we have this fair value gap. So price may not necessarily return to the order block because in confluence to this mitigation block, we have this fair value gap, which is within premium price level. So we can take another short entry at the fair value gap, our stop loss above the high, and then we target our sell side liquidity identified from the 1 hour time frame. So let's do away with the fib tool. So let's play price to see. Now we can see price return mitigated the fair value gap, also mitigated the order block. So in this case, we can see that price mitigated the order block. But I'm just showing us how to execute using fair value gaps in confluence to the Fibonacci tool, applying the optimum trade entry levels. So we can see that now we have a valid break of structure to the downside. And this is the best displacement model that took place here. We can see how price gave us a massive displacement. This displacement broke this structure. Now we can see that the market is pulling back to the upside. We want to use the fib tool to identify where the price is probably going to pull back to, and then we have the continuation to the downside. And what we can see is this is equilibrium, and you can see in confluence we have this fair value gap. So price has returned into this fair value gap, and this is equilibrium. So we could see price may fill up this fair value gap into premium, and then we have the bearish continuation to the downside. So we can execute another short position from this fair value gap since we identify using also the optimum trade entry level. And then we can put our stop loss above this candle high points. And then we can extend also our take profit to our identified 1 hour sell side liquidity. So let's do away with this. Let's play price to see. Now we can see that the market has activated this position also. So let's further play price to see. Awesome. So we can see we have this break of structure. We can see how price created this fair value gap here. We have this displacement to the downside that took out this low points. So let's use the fib tool to look into that from the high to the low. You can see how price pulled back into premium, mitigated the fair value gap, and then we have the fall of price to the downside. So we can now see that the market took out our sell side liquidity. So this is how you want to be utilizing the fair value gap in confluence with the optimum trade entry levels using the Fibonacci tool. So I see you guys in the next video. Cheers and God bless you all.